Back to Dion Talk. One of the most common questions that we get when it comes to real estate investing or reaching financial freedom through rentals, which is what I did, is how do you calculate the yield or your cash on cash return on investment? This is such a common question that there's thousands of videos on how to calculate the yield. But I got a question recently during a live stream where I was explaining that cash on cash return on investment is one aspect of choosing if a rental is a good deal or not. And there's about 20 other things we look at, and of all the 20, I think they're equally important. The cash on cash return is important, but it is one out of many things that say a deal is good or bad. And after about 20 minutes of explaining this, the next question I got was, would you buy a deal that is a 5% cash on cash return? That was entertaining to me. But the question I got recently, a spin on the cash on cash return on investment from FPM is, first they start with, this is a stupid question, but I don't think it is. I think this is a good question. Until you understand it, you should be asking questions like this. When you calculate the yield on a rental on year 2, do you include the cost to acquire still, or do you just add up your expenses and use that only? So that's the question that made me think I should make this video again. So the cash on cash return on investment, or what people call the yields if you're in accounting, is what is the return on your money? How hard is your money working for you? So a really simple equation is, if you invest $100,000 into a property and it profits $5,000, you have a 5% yield. If it profits $50,000, it's a 50% yield. So very simple math. It gets a little more complicated when you think, I want to know the actual cash on cash return on my investment, because you need to know this equation. This is the equation you want to write down. Annual profit divided by cost to acquire. That's the equation that gets us our yield. And I completely understand the question of, well, what happens in year 2? So this is the video of year 1, year 2, and year 5, so that you understand the concept. So the cash on cash return, annual profit divided by cost to acquire, means we need to define what those words mean. The cost to acquire never changes. We buy a property, and most people think the cost to acquire is the down payment, but you actually want to calculate the down payment, the closing cost, any money spent to make it rent ready. So if you need to do repairs, or if you're upgrading it or adding square footage or converting a den into a bedroom, or all those things that you did to make it the rental that you want to own. How much is your down payment? How much is your closing cost? Now that's things like the appraisal, the inspection, title and escrow fees, the $200 for the mobile notary. All of those things put together gives you your cost to acquire, including the expenses for making it what we call rent ready, meaning the next person to walk through the door could be the tenant after signing the lease. So that's the cost to acquire. You want to understand your annual profit, and this is the one that most people mess up. So if you're really brand new, you think, how much money did I make? Well, how much rent came in? How much did you get for parking, or for the storage shed, or for your laundry room, or any money that came in? That's income, not profit. Now you need to take out your expenses, and this is where the mistake happens. Most people take out their mortgage or their HOA or anything like that they see a standard expense for. Your lawn care or anything that you're paying for. And your mortgage is your principal, interest, taxes, and insurance, whether they're escrowed in your mortgage or you pay them yourself. That is your expenses that come out of your income. So then this is the mistake. People think, okay, I took my income minus my expenses. So if I'm making $1,000 a month in rent, and that's $12,000 a year, and I take out my mortgage, which is, we'll just do round numbers, $500 a month, they think that's $500 a month in profit, or $6,000 a year. That's the mistake. That's not the right way to do it. You have your mortgage, your principal, interest, taxes, and insurance, and any other standard expenses you have, or what people call the burn rate. Utilities you pay for, lawn care, any expense. HOA, if you're dumb enough to buy a rental in an HOA, just my opinion. And people forget about future expenses. Even a brand new house, you have it built brand new today, in 30 years is going to need a roof, possibly sooner. You could have foundation issues once it settles. Your water heater is going to last 8 to 10 or maybe 12 years. So you have these future expenses that you account for in your current rents. So depending on a lot of factors, how expensive is your market? If the cheaper the market, the more you need to set aside percentage-wise. So for me, in my high cost of living area, I invest in Washington State, near Tacoma and Olympia in Washington State, but outside of Tacoma and Olympia in Washington State. I set aside 15% of gross rent. So if I had $1,000 in rent, $500 mortgage, I would be setting aside $150 for future expenses, leaving me with a monthly profit because I don't have HOAs and I don't pay for lawn care service. I have that's in the lease that the tenants do it. So 1,000 minus 500 is 500, minus 150 is 350. So $350 a month in profit times 12, right? That's your monthly profit times 12 gets your annual profit. Now we'll remember the equation is annual profit divided by cost to acquire. So how much did you put down? Your closing costs, your money to make it rent ready, that's your cost to acquire. Divide your annual profit by that. That gives you the percentage, the return, the cash on cash return of how hard your money is working for you. Year one, a lot of people work on this. And that's about as detailed as we get. Most of us forget that we're going to buy a property. If there's a tenant there already, you might collect a month's worth of rent before you have a mortgage. We don't worry about getting that detailed in it. I actually don't run a cash on cash return to find out how much I'm going to make. I really only do this to make sure that of the 5 to 10 properties that I'm looking at in my market, I'm pursuing the one with the best yield and the one that checks off the most of the other boxes that I'll be making a video about soon on how cash on cash return is only one of 20 things you look at. So how does it work in year two? Because in year two, you don't have a down payment. You don't have closing costs. You don't have title and escrow. You would think, well, I'm making $350 a month now. I still have a mortgage. I still set aside money for repairs, but I didn't put any money down. So you think your return on your money would become exponentially bigger. That's not how we calculate it, at least not how I calculate it. So any accountants out there, let me know if I'm messing this up. But this is how I did it and how I reached financial freedom in about a decade on a low salary in a high cost of living area, and I never have to work again. And I just now travel places where the scuba diving's good, when the weather plays long. You listening? In year two, at the beginning of this video, I said your cost to acquire doesn't change. You paid a certain down payment. You paid a certain amount to make it rent ready. You paid a certain amount in closing costs. Whatever that amount is, you use that in your year two calculations. So now this is the reason why your annual profit, your cash on cash return, often looks better in year two or year five. Doesn't always, right? Rents can flatline, expenses can go up. But in most markets, your rent will go up if you use the binder strategy, which is how I get my tenants to ask me to raise the rent, which you can find at diontalk.com and take a free course on it, on how to actually get your tenants to ask you to raise the rent, which is what got me invited to BiggerPockets, where I'm the keynote speaker this year in 2024. Hello, Futureland. How's it going? And that's in October on the 5th, 6th, and 7th at Caesars Palace in Las Vegas. If you use the code Dion50, it gets you $50 off the price to go. So hope to see you at BPCon. Your cost to acquire stays the same for year two, but your annual profit can change. Your mortgage, your taxes might go up, your insurance might go up. Your principal and interest basically stays the same. They change, but the amount combined stays the same. And what's going on with your rents? Has your rents gone up? So same thing. What is your monthly expenses? Right, that's your mortgage. How much are you setting aside for repairs, maintenance, and vacancy? It's still 15% for me. So let's say rent was $1,000 and now it's $1,200. Instead of 15% of $1,000, it's 15% of $1,200 that I'm setting aside. So how much am I making every month times 12 months in year two, divided by the same cost to acquire, tells me how hard that money is working for me in year two. Same thing in year five. Your cost to acquire doesn't change. What was your down payment? What were your closing costs? How much money did you spend to make it rent ready? What is your profit in year 5? Because now, if you bought it in 2025, you would be getting 2030 rents with a 2025 cost to acquire. This is the beauty of real estate. Owning it long term, and having things like appreciation on multiples of what you put in happen. Rent increases over time. And because basically, and here's the last concept I'll wrap this video up with, because this is a nice short video that I make for those people who would never click on a 2-hour video and watch my Tuesday, 4 p.m. Pacific videos that last a couple of hours, where I usually answer every question that comes in. Unless I'm in Portugal and it's 1 o'clock in the morning and my brother's falling asleep. Then it might only last an hour. Rents don't usually go up at all. Rent today is about the same as it was in 1950. It's the dollar that keeps losing value. It takes more dollars to buy the same asset. It takes more dollars to rent the same asset. So what I want to do is I want to be the person who owns the asset who benefits from inflation. It's almost like Michael Zuber from One Rental at a Time made a t-shirt that said, "I used inflation to get rich. Ask me how."